Hello from the Tugascopy TV studio in Geneva. We are back with the technical analysis with Jean-Francois Owczarczak from the Management Joint Trust here in Geneva. Jean-Francois, welcome to the studio again.
Hi, Daniel.
So, the US dollar weakened versus the euro with the bad macroeconomical data that has been out from the United States last week. Do you still think this trend is going to continue, or do we see rather a weak euro dollar as a long-term trend?
Okay, well, let's have a look at the charts. We're here on our FinGraphs daily mosaic, so the perspective over the next few months. We have euro-dollar cable, euro-Swiss, gold, dollar-Swiss, dollar-yen, Brent, and the S&P 500 futures. So if we go into this euro-dollar investor's view, an investor's view is a combination of a weekly, a daily, and an hourly chart. It gives the perspective over the next few quarters, the next few months, and the next few weeks. At the moment, you can see that we have a long-term bear and a medium-term bull and a short-term bull, which stands for a potential pullback in a downtrend. So we're in a pullback period, or a consolidation period, against the larger downtrend of euro-dollar. So now if we look at it in more detail, and it's true that the patch of economic data has been deceiving in the US, and hence the euro is correcting up. The dollar was priced to perfection. People were seeing a lot of differential between US and European economic data, some divergent in the central bank policies. And indeed, if the cyclical upturn in the US is not as strong as people would have thought it was, does that differential justify that the euro is at parity, or would have been at parity, against the US dollar? So we do have this correction up. If you look at this euro-dollar weekly chart, so the perspective over the next few quarters, the targets we have reached the target zone, but they could still extend down to almost parity here. So we have 1,00925. They've reached the initial boundaries here of their targets, and they are reacting on some temporary exaggerations. You can see here the risk index was oversold, and both our envelopes touch each other. Then usually on FinGraphs, when the envelopes are still heading quite aggressively down as they are here, the probability is that the reaction that follows or is initiated is usually a temporary reaction. So looking at this chart, it's still in the bear, it still has targets with a bit of potential. We would consider the current move as being an intermediate correction. Now, to get more precision, we'd go to the daily, and the daily is also in a correction up. So you could see it's a correction because it's labeled C up, but it's also in gray color, meaning that the upward trend here hasn't gained enough momentum yet to be an impulsive move. And as long as we are in a correction up, and the weekly is still in a downtrend, we can hence confirm that the current move is not casting doubt over the longer term downtrend. If we do make it above these boundaries here, the upper boundary, which is at 118.55, the move would then turn impulsive, and then we would have a contradiction between the daily and the weekly. But at the moment, we're in a correction up, in a downtrend, and that correction up could have several more figures to go over the next month or so. So there's not much more we can say here, but what we can say is that at the moment, there's no indication that this correction up is quite over yet. It would possibly stop within the range, but if it does make it above it, then we'll have to reconsider. So correction up at the moment still has a bit to go, and no proof that we're going to move down very, very quickly over the next few weeks. The risk index does confirm this. It has seen quite a lot of exaggerations. It's moving up and it shows no sign of turning back down again. Now, if we quickly look at the hourly, we've possibly reached a first level of exhaustion. We've reached the 113 to 115 level, which we mentioned a few weeks back. When we went through the 109 corrective targets of the hourly, we do see a bit of exaggeration here on the risk index, which is overbought for a second time. We could see a bit of work here over the next few days, but in general, we'll probably hold it to what we see on the daily, is that we're in a correction up at the moment. Doesn't seem quite finished yet, but that's in the context of a longer term downtrend.
So if we look to the gold, it has gone through the psychological resistance of 1,225. Do you think that the resistance of 1,300 is now in the reach, or is the downtrend, long-term downtrend, still in place?
Well, what we see here is that at the moment, the weekly and daily charts, which give the perspective over the next few quarters and the next few months, are still on a downtrend. So we would still be negative over the medium to long term on gold. Now, the short term is correcting up quite aggressively, and it is the machine is telling us that we have a potential intermediate bottom, so a bull here, in a downtrend. It does seem that this move is not quite over yet. If you look at the target projections here, and we'll probably focus on them, is that we're not yet overbought on this move, and our targets show us that we can make it up between 1231. We're pretty much there at the moment, but possibly up to 1250. We believe that 1250 is an important level that we need to watch out for. So now let's widen the perspective and look at the daily chart. Well, the daily chart at the moment, it's still in a correction down following the attempt up and had in January. It did pretty much hold the levels here, and this correction down is labeled as done. We've seen multiple stress on our risk index in the oversold, and it seems like gold is giving itself a chance to possibly turn positive again. We're pretty much at an equilibrium yet. It hasn't turned quite yet, but we're possibly quite close to it. Now, the 1225 was an important level because it is actually the 50% retracement of the test, of the retest down we had between January and March. So if you take 1300 minus 1150, that's 150 points, divided by 2, that's 75, 75 plus 150 is 225, and that's what a lot of people were having a look at. Now, before we could break out of this base and have a much stronger move up, we believe there are other levels that need to be taken out because they are equally important. First of all, 1250 that we've mentioned on the hourly, which actually also provided strong resistance here and stopped the move up last October. And that level was also quite important, is that if you go back in time, it also served as an important support back in June 2014. So that 1250 is also going to be an important level that we need to see us move through. Now, once the daily turns positive, we have a bull here, the move was first calculated corrective up, so a grey correction up. And it would only move impulsive if you use the current volatility here, and I'll spare you the calculation, somewhere above 1260 to 1265. So 1260, 1265 will be another important hurdle that we need to get through. And then psychologically, well, the 1300 is also going to be important because that's where the move up actually stopped back in January. So we don't believe the sky is clear to just shoot up from here, and there's going to be quite a few tests until 1300 that need to be cleared before we can actually cast doubt over what is still a long-term weekly downtrend with targets between 1200 and 1000. The risk index is not that exaggerated yet to the downside. It's not yet oversold, and so until we could prove it different, this downtrend is still in place.
Thank you very much. And if we look to the stock markets, US stocks have really resumed their uptrend and found new highs last week. So what is your projection for the weeks to come, especially with the low macroeconomical data that has been coming out recently?
Well, it was interesting to note that bad retail sales, bad consumer confidence, actually bad consumer spending actually resulted in new highs on the S&P. And at the same time, you had gold actually moving up, which is usually a safe haven asset. So the whole thing was a bit abnormal. But when you think about it, well, we've been positive on the markets for the better part of now 3 years and continue to be. Our weekly charts, which show the perspective over the next few quarters, are seeing possibilities to create impulsive 2 targets around the 2200 to the 2400 level over the next few quarters. Our daily has had a hard time since December. A lot of people, and ourselves too, we're probably attributing it to the dollar strength and the market climbing a wall of worry. But when you think behind the dollar strength, what was actually causing it is the anticipation of a hike in interest rates and the big question of can the market or the economy support that? And now that the data which is coming in is probably less positive, that rate hike anticipation is moving out in time, and in a way is accommodative or corresponds to an accommodative policy for the markets. And that is probably what explains the breakout at the moment. It's a breath of fresh air because the hikes are probably not 3 months away, but probably 6 to 9 months away. And so at the moment, we're neutral here. We still are in a bear because of the consolidation, but there's no targets anymore, so they have turned positive. This neutrality in the long-term uptrend is then positive, and the short-term is moving up and could possibly make it up to 2130 to 2150 over the next few weeks. Earlier this week, we may see a bit of consolidation because of the exaggeration here we have on the oscillator.
Thank you very much, Jean-Francois, for being here today, and looking forward to have you back soon.
Thank you, Daniel.
Thank you. And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day now, and see you next time.